Hi, it's Matt Samet, founder of Fortress Financial, and I'm here to talk to you today about a couple terms in the investment industry that confuse a lot of people. Long versus short. You know, I could joke around right now and say, don't worry, this won't be too long and it won't be too short because it probably won't. It's going to be somewhere in the middle. Talking about this terminology is important because if you're an investor, 99.9% of the people are long, simply meaning they own something. They own stock, a mutual fund, an ETF, they own a bond, they own a GIC. That means you own it. So being long means you own something that you expect to go up in value. Now, interesting, you can actually own something that you expect to go down in value, and that's being short the market. Being short simply means that you think a stock or the market overall is going down in value. So believe it or not, you can make money in this. It's actually a nice thing. Smart money makes a lot of money during down times. I was a little embarrassed because in the last crash, I did extremely well in the '07, '08 crash, right into '09, where I made a lot of money. And you don't tell too many people that because there's a lot of pain out there, and the last thing you want to do is rub it in their face. But if you know what you're doing, you can make money as things go down. That's being short. How do you go short? In today's world, it's a lot easier than ever. You can own inverse funds. An inverse fund is simply buying something, but you buy something that goes up in value if the underlying security it's investing in goes down. Like, so say you buy something in the Toronto Stock Exchange, an inverse Toronto Stock Exchange ETF. There's three different types you can buy. There's one that for every 1% the index goes down, your investment goes up 1%. There's more leveraged ones that are 2 and 3-fold, meaning that for every 1% the market goes down, your investment goes up 2%. The 3 one is very leveraged, and remember, it works the other way, so you better manage these properly because obviously in any investment, if you buy going long and it goes down, you lose money. If you buy to make money going down and it goes up, you lose money. But the 3-to-1 means for every 1%, it goes up 3%. So if the market goes down, say 20%, and you were in a 3-to-1, you'd make about 60%. So a 20% correction in the market, you make 60%. A lot of people made killings. I owned, the biggest one I made was the inverse ETF on U.S. financial firms in the last crash because it was clear. Anyone who understood the game, it was clear financial firms were leveraged, a mess, potentially bankrupt. So anyone buying these inverse ETFs made huge profits. How else can you do it? Make profits on the short side. You can buy puts, which are options. I'll probably do that in another video for someone who really wants to understand that. But just know that if you're short the market, your goal is to make money as something goes down. If you're long the market, your goal is to make money as it goes up in value. You buy a stock at $10, goes up to 12, you made 20%. Not bad. That's being long. Hopefully it makes total sense, and we'll catch you soon on another video. Take care.